Morning traders, welcome to the Traders Lab. I'm your host, Tom B. Hope you're all doing okay today. Uh, be sure to grab a pen and a piece of paper. I'm going to be going over some integrated concepts today, which might be a little contradictory. And the reason for that is I'm going to be discussing multiple time frames or vertical integration. And part of the vertical integration of behavior is to be able to think of time frames really inside each other. And that may seem contradictory. So, and the reason for that is, think of it as when I say vertical integration, it's almost like a vertical chess game. So we in a multiple time frame environment, we may have a long lean in a high time frame and a short lean or trades in a shorter time frame, trading rotations inside of each other. And the shorter time frame, as you think of it, you go down, the more these rotations can be somewhat counterintuitive. So then the thing becomes, do you only trade primarily from one side when most of those time frames are in alignment, or subject to the rotations? Are you trading inside in shorter time frames? How do you put all those pieces together within the psychological conflict that is presented? I'm going to try to address that a bit today. So let's focus, and I hope you get something out of this. And I actually hope I can deliver what I say I'm trying to accomplish for you. So let's go ahead. I got a lot to talk about, of course. So let's go. General disclosure, all Bookmap Ltd. Materials, information, and presentations are for educational purposes only and should not be considered specific investment advice or recommendations. Risk disclosure trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Please remember, this isn't a trade calling room. We get there, we talk. Now, a couple things to go over. Remember, Bookmap Academy coaching sessions have changed to Tuesday at 4 p. Eastern Standard Time. Previously, they were on Thursday. They have moved. So if you've been wanting to get some coaching or some review and potential critiques of your trades, gain a little insight, be sure to take advantage of it. There's no cost in the Bookmap server. Also, there's a few more things here. Bruce's pilot program. We all talk about edge. And edge, how do you get edge? How do you determine if you even have an edge? And the difference between an edge and a gambler is edge puts statistical probabilities on your side. And of course, like everything in trading, the outcome is random. And in spite of having an edge, you're still going to have losing trades. We all do. But same as the casinos, they only play games with edge. And that means in a random distribution of outcomes. So, the gamblers do get paid and we do take stops. If you have a statistical edge and you can actually execute it, then over a random distribution of outcomes, the edge favors you and potentially the dollars can flow over that financial table to you. So edge is very important. If you don't have an edge, you're really sitting with the gamblers. Now, I would say be sure to get the tickets to the buffet and the cocktails. Now, there's 60 PDFs of structured trades that I have shared in the Trader Lab. There's no cost for this. And these, I am not sharing a trading course. What I'm sharing is 46 years of experience and ideas of market mechanics. How does the market work? Why does it do what it does? How might you at times get in alignment with it? And these are various trades. Traders were asking me, what are you doing? And I posted some of these. And also some of this is research I was doing with Bookmap developers on some ideas. Some have been integrated into add-ons, others, as they say, with research, where they end up. So, but that's what this was. And you can see some of these trades, but you must reverse engineer them. There's no such thing as plug and play. Isn't that unfortunate? Because then we could all get that truck to move the ATMs in the basement. This is the process hierarchy I share in Trader Lab, and all it is, what this is an integration of Bookmap order flow tools, seeing inside, you might say, of participant behavior in an auction. What is the auction? This is the basic process of trading. Why do we even have a market? To figure out what's too high, what's too low, what's fair. Now, it's talking at the top of the stream about the vertical integration of time frames. This idea of auction happens in all rotations. So subject to how you put these vertical time frames together, you can have an auction that's going up. You can be trading the shorts in a shorter time frame, and this can be very confusing, right? Well, I'm going to try to address it a little better because it's hard to do in a short stream like this. But if you come to TraderLab, there's a lot more information there, a library of webinars, a document section, and you can pick some of this up. And again, there's no plug and play, nor no shortcuts. Sorry to disappoint you. Don't we all wish? Now, the volume profile is a distribution of volume, and really it's a representation of the auction. What's too high, what's too low, what's fair. And in all fractals or time frames, the market's trying to figure this out. So if we can see inside these vertical integrations and think Russian dolls, Matryoshka dolls, it's a very simple way to think about multiple time frames. Then maybe we can make some sense out of it and identify outside edges. In other words, what's too high, what's too low, what's fair. The market's always trying to find out where is their agreement where buyers and sellers will do business. And think of your shopping experience. Go to supermarket. If the price is too high, somebody will pay it, but the volume dries up. And then if the sellers want to do business, they have to lower the price to attract the buyer. But what happens if we go to the other extreme? The price goes on sale. I know, you're an astute shopper, you throw 4 in the cart. So do I. And then what do these sellers do? Well, because there's demand at a discounted price, the price then will equalize and potentially come back to retail. This creates our rotations. Now, if you think about it, that's what's going on in the market, except for us, it's in real time, and your supermarket, yawn, they move the prices when they put it on sale for 2 days or a week. You know what I'm saying? It's a different time frame. Now we understand, don't we, what time frame is? And if we understand time frame related to shopping, maybe we can take that and move it here. And then Bookmap is the order flow tool. This is where we get inside that participant behavior. And it can help us to see change in behavior, where the sellers take control, where they get absorbed. And now we get into more nuance. And this all creates edge. Are you guys getting something out of this? Let me know. Does this make sense? Hope so. So let's get into Bookmap. Now, before we go to Bookmap, I have to take you back to go forward. This is day before yesterday. 90, this orange line in this consolidation, this is what time frame is, right? This is an intermediate time frame. The orange line here at 90 represents the fair price. Remember, shopping. Oh, it's on sale. Up here, all-time high. I'm not paying that. Get out of here. Retail price. Day before yesterday, the high is 90. I'm not paying that. Okay? And then we have sell stops here, a gap, and 95. What's at 95, you ask? The retail price in this consolidation. Oh, it's on sale. I'm not paying that. Retail. This is this multiple time frame concept. So if the market gaps here and finds I'm not paying that, then the possibility is if the market is long to come down, get sell stops here, sell stops here. What's the other concept I always say? Market goes up. Now this was news, so disruptor to go down. Market goes down to go up. Market goes up to go down. Market goes down to go up. Market goes up to go down. Market goes down to go up. To go up. To do what? To go where? Market goes up to go to 95. I think we got a little below 95, but this is the auction. I'm not paying that. All right, where are the longs? Under there, the gap. Where's the retail price in the last auction? Over here. Oh, really? It's on sale. Come on back. Are you guys tracking? Is this making sense? Now, a little further. This is what it looks like in the profile. If I can get this on here. There's your 90. This was the day before yesterday, 90. Now, this is the retail price from day before yesterday. We opened here and we did the Acapulco cliff dive. Now, in yesterday's stream, I narrated that we had shorts only all day. 55 was an outside edge, but remember, sell stops. And then we had the gap. Down we went, down we went. What was down here? Now, remember, 6707 was a target. And if you didn't see yesterday's stream, be sure to look at it. And Dan, if you're in here, or Stephen, can you please post yesterday's link in YouTube, so if anyone wants to take a peek, they can. And then we had 66.99-ish, low of the day. Who knew? So this is yesterday. Now, this sets up something else, and this level might be a little bit off, but you'll see it accurately in Bookmap. This is called the value area. What is a value area? Now, this is all market profile edge. All right, so let's not get too, upset about this. If you don't understand the profile, you can learn this. This is how the market works. There's no indicators here. Why would I want a lagging indicator and also to create conflict? I want to get to where the financial rubber meets the road. Believe me, been there, done that, built trading systems. I started trading in 1980. So whatever developed along the way in technical indicators, I was on it because I was looking for the answer. And all I found was more conflict. So this is where 70% of the volume took place yesterday, more or less. And this is the retail price or highest volume. Remember the shopping from yesterday, 37-ish. Remember, ish. So I know that 72 or 71-ish might be too high. And I know 28-ish might be too low. This is where most of the volume, this is your shopping experience. Now, price-wise, this is too high. And this thing from the Acapulco cliff dive is too low. If we clean the longs out who are in the leg up, then once they're out, we can rebalance. So let's see what might happen. Now we go to Bookmap, hopefully. Okay, so what do we have here? This is the 37. This is the retail price. This was the fair price from yesterday, and we can go up, down. The settlement price, I believe, I think it got covered up here someplace. Hold on. I think settlement was right around 37. Is that correct, everybody? Can I get a confirmation in TraderLab? 37. Okay. So let's look at this. We are now, take out your context grid sheet. Now you're in TraderLab, you have these. These are some of the tools. And we use the context grid sheet to give us an idea of the opening behavior so we can anticipate behavior, not predict it. Guys, prediction, not part of the business. It's a business of alignment, not of prediction. Psychologically, we want to predict, and unfortunately, predicting shuts off the other possibilities and creates rigidity and the psychological need to be right and becomes stubborn and all the other stuff we do. Well, we're not in the business of being right. We're in a business of probabilities. I hope you know there's a big difference. So we're opening in range, higher in range. So let's not forget that. Higher in yesterday's range. What does that mean? Of course, between yesterday's high and low. Don't come after me with a broom. I'm just going over the parameters, okay? Now, there's another piece. The overnight volume point of control. What is this? This is called the naked volume point of control. Now, I'm spending a little time on this because I want you to see how pieces might fit together. This is the highest volume from yesterday's RTH. Fair price. Remember, your supermarket. The last auction is the ETH. So this is the high volume from the last auction. It is higher than this one. So that might mean, we might say is maybe that here is too low. Let's go a little further. You say, yeah, where are we going? ETH high. Okay, that's nice. Where's that ETH low, by the way? All the way down here. And this is called value area low. Value area low, remember, 70% of the volume. Outside edge. So I'm opening in range, higher in range, in value. You're going, oh yeah? Yeah. Value area high. All right. Well, let's look at probabilities. Now, notice what I'm doing, other than putting you to sleep, is this is what is going on in Trader Lab about trade plan and creating statistical edge. Before the first trade goes on, this is part of the process because you need to know what to anticipate, not what to predict. So what does it mean? If I open in range, in value, what does it tell me? According to my grid sheet, the market's in balance. What do I anticipate? Possibly a neutral day. Neutral means taking out the first hour's high and low, or a low conviction day or rotational day. So I'm anticipating potentially two-sided trade. So that's the first thing. So are we breaking out of the prior day's value area? Well, not yet. So what does it mean? If we don't break out of value, then the market's in balance. What do we look to do? Trade the outside edges or the value area extremes. What does it say? Well, market sentiment hasn't really changed. We're in a fair area now, and we can slosh back and forth. Now, if the behavior changes, we change. Now, statistical probabilities. You didn't think you were getting off the hook to have a trade plan and to try to develop an edge. Let's look. We're opening higher inside of yesterday's range. And don't forget, in value. So what are the probabilities? You say, well, the first one is to get to the naked volume point of control, and close your eyes if you're going to be unsettled by this, is 68% probability to go there. All right. Overnight volume point of control. What's the probability there? 81%-ish probability. And you have to bet these for yourself. Taking out the previous high or low, well, 82% probability, but then again, maybe not. Okay. Getting to the previous value area high, 72% probability. And there's a little bit more to this. Taking out the first hour's high, 66% probability. So we're leaning towards taking this out. And we could also take out the first hour's low, which is down here. And they're almost even. Why would they be even? Because I'm opening in a fair area. All right. And there's more. You say there's more. Yeah, there is more. Did I get the ETH high? 76% probability. So I have, let's come back, 82% probability. Losing my mind again. Hold on. ETH high, 76% probability. Value area high. This is, and now there's more. You're going, yeah, 72% probability. What does that tell me? I have an upside lean. I'm open, and that's because I'm opening higher. And the other part is retail from yesterday, new retail price from the last auction, high probability here and maybe there, and maybe down, right? No. So, but what else do we know? This is not on the sheets. This is where you have to understand market mechanics. Why did the market go down potentially? Because the market was long. The stops were under the market. If the market is long, think of it this way. Market goes up to do what? To go down. And what else? The market goes down to go up. Why does it do that? If the market's going up, there's sell stops and there's longs in the market. If the market does the Acapulco cliff dive yesterday, what else do we know? There's now shorts in the market. And you'll notice if we look at yesterday, and again, I'm coming back to everything before the RTH open. This is the beauty of having an understanding of how the market works. But let's look at this. Now, this is yesterday, okay? The market gapped. What does that say? There's stops under here. There's stops under here. And yeah, we either were going through the 90, which is our resistance, which we checked the day before, or we're doing the Acapulco cliff dive. Now what's in the market? Longs here, longs here, longs here. What did we get yesterday? Take out the longs, get the shorts. What do I have here? A tail. What else did I do? 95 was my primary target. Oh, it's on sale. I'm not paying that, you see? So what do we anticipate? In here, two-sided trade. Now we can take this out, we can do whatever. Nobody knows. This is the fair price from yesterday. Also, this was the gap. Where did we close? Right back inside. What does that suggest? Maybe we wiped out the weak longs, and now we got the shorts. And now we can do what? Squeeze these guys out. So we're throwing these guys under the bus. Now we can throw these guys under the bus. It's a mutual abuse opportunity. So that's trading, guys. Are you guys with me? Okay, let's get going. This is all before the first trade. Now let's go to the first trades. Now, these are not trade recommendations. You have to vet everything for yourself. Let's go. Let's just go take a look. So this is called developing volume point of control. Now, what are my probabilities? I got a high probability coming here. I got a high probability going there. Statistics favor the upside. I'm opening in two-sided trade, right? I can rotate. I can do anything. I have no idea. Do you? So I don't know. Let's look. So I get my buyers. Don't forget the market's short. So my inclination is, well, what do I do now? Well, I got a high probability there. I got a high probability here, and I'm opening in range and value. And I know the last auction, the ETH is there. So my inclination is, depending where I come down, is to look for a long initially to get the profit taking or short covering. That's what I know. So I get my buyers here. So I see this, and this is represented by the delta. So all I'm doing here is I'm showing this is delta and this is delta. They're the same. So I see my, on the open, buyers, and now I see less buyers. I see right here some sellers, and now big buyers. So what I have here is the buyers here, and I see the sellers here. This is called developing volume point of control. And as it changes, it's measuring the volume. Now, this is called the variable high volume node. I made them up. So that is my first suggestion, that this might be too low right here. However, I got to be thinking of this, and I'm thinking of that. So I've got what you call what's happening. I get my sellers here. There's my delta, and I get above them. So now I'm telling you exactly what I'm thinking. I'm looking at this. I'm saying, oh, I missed it, right? Isn't that what you say? So then FOMO. Do you guys ever feel FOMO? I feel it all the time. And why do I feel it? Because I'm wired to feel it. But what do I do? Well, as a trader, I have to manage my emotional states, and that's what the trade plan is about. It doesn't mean I don't take stops. It doesn't mean I don't even make errors. I'm still human. But over time, I've learned to get patient. I just don't have to do anything. And if the trade gets away from me, I know that I have confidence that there'll be another bus. Think of it like shopping. So I get my buyers, and I am anticipating short covering. I get sellers here. Now, what am I actually looking at? This is icebergs. And what are they? The passive side. So the delta is the aggressors, and aggressors are made up of buyers, initiators. But who else are the buyers? The stops, market orders, right? Delta shows up. So stops and initiators, so whoever's buying at the market shows up as delta. The passive side, we don't see them, but what we see from the passive side is absorption and then the reaction. So here I have sellers. These are market orders. And you'll notice the sellers are pretty darn strong. This is my support. And I get buyers above the sellers. So right here, the buyers are in control. Who knows? So basically, this is where the buyers are. Sellers take a shot here. It's those guys come down. This is support. I'm looking for it to come down. And then now another piece, and I'm trying to discuss multiple time frames. So forgive me if you're confused, because it is confusing. If I have my sellers here and I have my buyers here and I have this retail price, then this is support buyers, and I get these guys. Now right here, it's I got more sellers here than I have buyers. And that's because the delta is higher. I come down again. Now this is my support, and right here I see selling delta, and so there's sellers in here, but it's not going anywhere. And then I get my buyers above them. Oh, I forgot to mention, when you open in range in value, and you're opening in a fair area, then we anticipate the potential for two-sided trade. What I do often, and again, it's subject to, nothing is mechanical, at least for me. And what I attempt to do is use now the order flow to suggest to me what might happen here. So two-sided trade. So I got one side here. What does this mean? Opening swing low is right here. So I have to mark this. I'm going to call this opening swing low. All right. And if I'm anticipating two-sided trade, I anticipate slosh. So this is the opening swing low. And if it goes up from here, now if it goes up and keeps running, I'm out of luck. But often what happens is if we open in range, in value, I'm anticipated what? Two-sided trade. So now I'm looking here to see if I can get these longs out. Because right now the longs are in charge. All right. Now my first suggestion of change is right here. This is a sweep. So what I have here is a sweep and my buying. So right here, it looks like it's going to keep going. The sweep suggests to me the potential for counter rotation. So right now I got support here, opening swing low here, and this is like what's happened. Watch. I got my buyers. I got my sweep. My sellers are below my buyers. Now right here, either these sellers are, so these guys are absorbed. What I don't know now is if these sellers here are going to take control, or if the buyers are going to absorb from here, are going to absorb these guys. So let's just see what happens. Sellers are here, buyers are here, sellers are here, sellers are here, sweep is here. Watch. Back below here, what does that tell me? I got my buyers here, and this is support. Again, opening swing low. Sellers are now here, and where's my location? I'm taking my time here because I want you to understand how you can put a plan together. We opened higher in range. What's the statistic? 68% probability of getting there. Now, what do I have? I have my opening swing high here. Going to label it. And now, I'm taking out this first swing, which was here. So I've got my two-sided trade. I now have my shorts. As far as I know, going to zero. Statistical probability. Don't know. Right here. Now, this is a structured trade for me. Now, the thing I have to figure out is, where do my buyers take control? Do they take where? It's like there's no precision in this. So let's look. I'm under here, and as far as I'm concerned, at the moment, we're going to go lower. The sellers are here. There's the delta, but here's the large delta. So this is where the aggressive selling is. And it's also the stops from these guys under the opening swing low. Thanks for playing. You get a coupon to the buffet. Now, here, notice what's going on here. I'm getting less selling. So the market's price is going lower, but there's less. Now, right here, I see a little nibble on the buyer. I see a little nibble on the buyers, and I get my break high. Now I have my break high. I've tested this. Now I have to get long. That's my deal. So where was the last place it was too high? It was right here. So now I've got to get long. I'm above my variable high volume node. I can buy it here, and my stop has to be here. There it is. That's my long. Heath chatter. So I get my buyers here, and I have my aggressive buyers here. So I have this, I have this, I have this. All of this suggests long. Now, what's my statistical probability? First target is here. And what was that? You wrote it down, about an 82% probability. Remember, you have to bet everything for yourself. And then what else do I have up here? ETH high. What's the statistic on that? 76% probability. And then I have value area high. Remember, two-sided trade, I'm anticipating this. Next target. So for me, long, scale, next target. Notice the liquidity. Target. That was the long. Now you could be done. Anyway, let me go a little further to show you further behavior here. There's a little bit more to this too, of course. Watch. Now, what do I know? Absorption here. Buyers took control here. Support, variable high volume node. Notice what happens up here. Now I'm into order flow. This is my target. I get a sweep. Okay? Notice what happened here. I had a sweep. Counter rotation. Having a wonderful time. And now this is sitting in the book. Okay? I get my buyers. I get my sweep. This puts me on alert for a counter rotation. This is where the teeth chatter. Now, subject to how you use order flow, you can scale ahead of this. Or you don't. That's your business. Counter rotation. Now watch. Where is my support? Isn't it in this area here? Let's see. Isn't it right there? This is called the variable high volume node. I made this up many years ago. And I started using it to trade because instead of using indicators, I changed the way I look at the market. I used to let the indicators do the heavy lifting, but they're all lagging, conflicting, and who knows. So when I figured out this auction, and it took me a long time because what I was doing back in the late 1980s, and I learned market profile from Peter Stottlemyre. He created it, and this wasn't the way it was. But I observed behavior, and I'm a researcher, and I dig into things. And unfortunately, I dug into a lot of things also that I had to throw away that had random winners, and you try to make it better. But instead, let's talk language. So what do I know? These guys were absorbed. There's the icebergs. The buyers took control, and the sellers are being absorbed here. The sellers are here. What is this? This now is an outside edge of this developing structure. This is like, oh, it's on sale. Retail, I'm not paying that. And this is the ETH high. ETH volume point of control, 82%-ish probability, and this is your obstacle. If I get my sellers here, and I come to my location, and I know there was absorption here, why didn't it go down? Buyers. What about why didn't it go down here? Absorption. Why? And now what happened here? Absorption from the other side. What happens here? Sellers are trying to take the ball, but the absorption is here. Location, real estate. Back up, next target. Subject to, now I'm talking time frame, remember? Subject to time frame, you could be buying this, you could be buying this, you could be buying this. See what I'm saying? And you could also be taking stops like the rest of us. Now, where's the next probability? ETH high. Here. ETH high. What was the probability? 76%-ish. vet it for yourself. Now I've got this. What is this? Order flow phenomena. Buyers. What happened here? What are these guys? Icebergs. What are they? Limit orders. What happened here? Absorption. What does it do? Counter rotation. Doesn't have to. If I break above it, it can become support. This, now I'm going to get more advanced on you. Don't get mad at me. Resistance, long, location. I know you're going to go, I can't do this. Throw your hands up and go running with your hair on fire. But resistance becomes support. Break high. Break high. This is an order flow trigger, subject to, not saying it's any good, just saying it's something you can learn. Support, support, outside edge, support, VPOC migration. What does it say? Language, too low, new retail price. Oh, well, we should have bought more when it was on sale, don't you think? Now what? Resistance, statistic, and one more above. Sweep. This here is support. Resistance, you know the old saying, VPOC migration. Now, this is an advanced method right here, and it has more risk associated with it if you took a long here. You could, and this is where the resistance was. Let me draw a little box for you. I'm going to try to get more to real time fast, but because I never know what is really helpful to you guys. So I'm just going to try resistance, absorption, rotation, break high. This is an order flow trigger. VPOC migration, new retail price, new retail price. And if I come outside, this is my support. I can be putting my stop under here for trailing. And where am I trying to go? Good question. Here. Sweep. Now, this is support. Let's just throw a little box around this thing. And there's a couple pieces here. Let's look at the pieces. Resistance, absorption, those guys. Thanks, Lewis. Support. Thanks, Lewis. Resistance, support, resistance, break high. This comes support, outside edge. What was the probability to get there? All I'm doing is alignment, statistical probabilities, and what was the context? Shorts are in the market, and this is the squeezeteria. Remember, the market goes up to go down, the market goes down to go up. Value area high, 72% probability. For me, this is where it ends. Not saying it's a good idea, just saying. I trade the targets. Look what's here. There. So for me, sweep, counter rotation, support. So sweeps, sweeps, sweeps. What else is happening up here? Less buyers. Now, I'm showing you multiple things, and obviously, to be able to read these vertically based elements, you absolutely need to learn the tools. Now, the volume profile is not hard to learn because you already know how to shop. What's happening in multiple time frames in all of these are auctions. This is an auction. This is an auction. So in the developing daily time frame, it's all auction, one big day. As I go down in quote time frame, and this is not regulated by the clock, so forgive me, there is no time frame in the developing time frame because it's not clock based, it's participant based. So right here is resistance, right there. And my support is down here. If you look over here, this is a consolidation. All I'm doing is, this is too high. I'm not paying that. Oh yeah, but it's on sale. Retail price. If I leave this, then this retail price, think of it like your mini mart, is too low. And then I leave it and then I start this again. Too high, too low, too high, too low. Retail. Oh, really? Too low? I'm out of here. Too low, too high, too low, too high. Retail. And that retail is right in there. So too high, too low, high volume. If I leave it, it's telling me this is too low. I go up again. Now I'm coming to the outside edge. And there's a little consolidation here. Too high, too low, retail, too expensive. I'm out of here. Buyers. Now, this is my target, by the way. This comes into the book. Because I have an order flow tool, I see the sellers here. Now, the fact that they're here doesn't tell me what's going to happen. It tells me what might happen. I got them here. Why didn't it go down here? I don't know. You? What I know is if the liquidity is here, don't forget I'm trading probabilities, and I can get above it, this retail price, which is here, break low, supports here, don't forget, come back. If I can get above it, now I have the volume here, which is too low. Break high, I got liquidity sitting here. Little micro high volume structure. I see a sweep. What do I anticipate with a sweep? Counter rotation. What do I anticipate with a sweep? Counter rotation. What happens if I don't get it? I go up. This is now support. Too low. Target. Now for me, trade's done over here, but I see, because I have no idea. I am the clueless one. But one thing I do know, shorts are in the market. I do know that I had a 72% probability-ish of getting there. I know I can come out here and then come all the way back inside. I also know that the first hour's high has about a 67%, 66% probability, which is this. Okay? So I know that if I counter rotate, I can still go for this. And then if I look above and I see this is the current high, so we did take out the first hour's high. Let's look further up the financial food chain. Yesterday's high. What is the probability of yesterday's high or low? Where is it? Lost it. 82% probability to take out yesterday's high or low. Now, let's come back to something interesting. This is yesterday. Which one of these do you think is probable? Yesterday's low or yesterday's high? Which one? If this was the Acapulco cliff dive and we close back up in this area, which is this consolidation after the gap, and now we're back here, and we have an excess low, right? And 95 was the target, right? Then what? Is it possible we take this high out and we have another target? Where is that target? There. So we have yesterday's high, and we have this. And remember, the market never has to get there. What else do we know? We're outside of value. Now let's look at our context sheet. What happens if we get out of value? What do we want to do? Potentially trade in the direction of the breakout. And then the next piece would be, do we get outside of yesterday's range? But not worried about that one. So this is my next area, and I have the possibility for long continuation trades. Is everybody tracking? Remember, today I'm focusing more on a vertical integration of time frames. This was too low, the retail price. Remember, shopping. This is outside edge, and now we have the shorts who we are squeezing. All-time high is up here. The 90 was our resistance. Remember, top of the stream. This is called the naked volume point of control. Same as that. Retail price from yesterday, highest volume. And what about this? Highest volume from this day. And we just missed it on yesterday, and we did the Acapulco cliff dive. But now the shorts are here, and the buy stops are over yesterday's high. That makes this a potential target. And of course, as they say, past performance, not indicative of future results. And that sets up another structured trade, if I can get over here. So now let's move forward, maybe. Okay. Now this is now nobody knows except we have a target here in a higher time frame. This, around 67. Not going to go into it too much, but I want to show you how this works. Buyers, 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 buyers going to the moon. But what do I notice here? Less buyers, less buyers, less buyers. Delta divergence. You guys know about divergence. So do I. What about this? Delta divergence. Sweep. Looking for the counter rotation. Where's my support? It's there. So right here. Oh, it's over. Jumping out the window. Well, maybe not. Liquidity comes in. Notice the delta change. So it was buyers, buyers, buyers. There's the sellers. It's over. Well, look, I got more buyers. Buyers and now big buyers. So the buyers still have a ravenous appetite. We are squeezing the shorts. So the shorts become buyers and new buyers. So you got buyers and buyers. Short covering, who are buyers. Now these are icebergs. They are sellers. Now, so what happens is on these rotations, there's your liquidity. You can see it with an order flow tool, and there's your sellers. Now, part of the thrill of this is we don't know, are we going to break through this? Or is this like somebody put up a roadblock? Well, now, if I come back across the range, I know that I have potential support in this area. And of course, I can take it out. Nobody knows. Part of the joy. So here I get below. And now look at this. This skews the book. Now I have my first hour's high here with a high probability of taking it out. What am I going to do? What are you going to do? Well, I got to start looking. I want to be long, but I'm still inside of this value area. So I came outside, I fall back in, and that sets up the probability. I'm still in a two-sided configuration. My probabilities suggest I am going to come out the top. But who knows? So if you were long, subject to how you manage your trade, and remember this, and now VPOC migration, this is the retail price, this is resistance. My buyers are here, my buyers are here, and you'll notice the delta divergence. Now, I don't know, like you, I have no idea. Now, I see my sellers here. What else do I know? I got longs in here. Well, if the longs, we've run out of buyers, and I got this is now my resistance. The other piece to this is I noticed the order flow. See this, the limit book, all this limit sellers are coming in, and that's what's over here, except I'm seeing it in the heat map, so I'm not looking here, looking here, looking here. I can see it. So I see this coming in. Now, do these guys want to trade, or are they skewing the book? Another element of order flow. Here's my support. There's my mid. This is my retail price. And you notice now I'm below the buyers, the big delta. Here's my sellers. And now this is what's interesting about this. I do see my buyers, but where's the meat on the bone here? Buyers are weak over here. Buyers were strong here. So where's my buyers? I don't know. Sellers don't look like they're such a big deal here. I got a lot of buyers in here, but I got this. Now I got this. This gives me what you call discomfort. I break low. Now, when I break low, I'm now below these guys and I'm below these guys. And now my support is going to be here, here, and here. So as far as I'm concerned, when I come out here, it's possible these sellers can get squeezed. So when it comes out here and I have support here and I'm suspecting I'm going to take out the first hour's high, statistically, I'd be looking for a long out here. Now, and this is where you might look for a long. Now, the thing about this is we got longs in here and now we have our sellers. So what is going on here? Are these guys strong? So in here, when I'm looking at this, I'm thinking, well, I got a high probability, but it's not until 9:30 when the first hour's high is locked in. So I'm thinking at the time, this is now resistance, and I want a continuation trade. So I'm looking for longs. I'm looking at this and I'm thinking, okay, where's my support? Let's start marking this. So what I do is I mark these the same way I mark this down here. Okay. I'm marking the progression of the buyers. And so the idea is the buyers thought this was a good price, and now this is the retail price. If I come outside somewhere, I can look to be a buyer, come back here. This is called mean reversion, and potentially come out the top. That's what I'm looking for. Now, what happens, happens. Where's my support? It's here. So here I was looking at it because I have this, and let me move this over. This is where my order flow support was, and this. So I have this confluence here. This is a long right here. And the idea of this, once right here, is to come there. And a stop, okay? Now it is, what's going on? So we had long, stop, and now this is the next area of support down here. This one, variable high volume node. I got to put it in here. I didn't put them in. Hold on. By the way, I can't see your questions if you have them. You know, I'm in Mexico on a laptop. A lot of this stuff, the chats get lost. So I'm going to stop in a little bit and try to get our chats back. So this here, you know, this area here is a long, and the idea is to go there for a scale. Okay, no bueno. So now my next area is here and here. Let's extend it. So I have no clue. You know, there's no secret sauce here. Just try to get this back where it was. I think that's kind of where it was. So I'm looking at variable high volume nodes. My buyers were here. This is my location. Liquidity in the book, location, watch. Now, this is resistance, break low, test, sellers. I'm in an area. I've got this coming in here. So I've got resistance at this liquidity. I got support, location. And what else do I remember? This. So I've got a confluence. Now this, difficult. What happens here? These are all the sellers in this leg, and there's buy stops in here. Sellers, you can see it here also. Sellers. Now my buyers come in. Now I get big buying here. So now I get VPOC migration, and I have this resistance. Let's see if we can't make some sense out of this one. Sorry, guys, I'm trying to drag this. Okay. Sellers are here. Resistance right here. See it? Sellers here. So think about this in multiple time frames. If the sellers are here, we're looking for it, to go wherever. And I am inside an environment of two-sided trade. So I'm still thinking that I can sell it, but I know I have an 82% probability, right, to get yesterday's high. Since I don't think we're going to get yesterday's low, which of course we can. So now I get VPOC migration. So I know I got support over here, and this is now the retail price. I got to mark this same thing, variable high volume node, too high. Remember shopping. Oh, I'm not paying. Wait, I got to get your chats back. I can't see them, but I want to get caught up. I'm not paying that. Okay. Buyers, sellers got stuck there. This is where it changed. And there, my liquidity. See, so I have a couple of elements. Now this is an outside edge. So retail now too high, and I have too low down in here. Variable high volume node. This is going to be resistance if we can get there. Resistance is here. Don't know, by the way. So support is here. Variable high volume node. Going to label it. And you'll notice how this moves around. What it is shopping. So it's kind of like the market is looking for fair price. And when a price gets maybe too high, it becomes resistance. If the price goes on sale, they lower it. Do we attract the buyers here, or do we push off it? Well, we break above it. That says potentially too low. So I got this. I have this. Come up. So what you have to be doing with this is you need to be trying to get in alignment. And the part of the thing about today is we're looking for two-sided trade, but we are leaning to the upside. Look at the volatility. Sweep, counter rotation, obstacle. You break through, it becomes support. And then right here. So this is the IB. This has your first right above here is we had that, what was that probability? Let me try to find it again. Lost it. 66% probability to take this out, and you have this. Now, let me make something very clear. I'm showing you market mechanics. These are not necessarily trades that anybody should take. For me, I'm not trading this like this. What I do is I trade the broader brush stroke. So to this. Now, when I get the IB extension and I come back inside, I know here's the possibilities. Now, this is going to be from both sides because it's either counter trend or whatever. If I'm still inside the value area, after taking this out, I can come back here. One possibility. This is called the IBF. The other and it's in conflict because I also have, and don't forget, look at this. I also have yesterday's high with about an 82% probability. So I have choices. I can go, well, the market is short and there's buy stops over yesterday's high. Do I want to fade the side that's getting squeezed? Great question. Or do I only want to take longs because I'm playing a probability to come there? See, the answer is in your trade plan. And all these trades can be correct. But for me, so I can come back here and rotate, or if I come outside the IB, which is set at 9:30 Central Time, so here's the trade. I can go short from here to there. Or I don't take any shorts because the market is short and I have an 82% probability to go there. What would you do? Now I'm going to go take a look at the chats. And again, sorry about not being able to see them, but laptop. Let me try to get Discord back, TraderLab. Try this. How we doing, guys? How we doing in YouTube? And how about you guys in the Discord TraderLab? Right ideas in YouTube is asking me if you should trade the open, when should developer traders start looking to trade? They shouldn't look. The open's the highest risk place, in my opinion, to trade because there's no structure. Developing traders shouldn't trade the open. They should narrate the open, but they should never trade it. It's the last place because you have nothing to lean on. You can, and the speed. So there's nothing to do on the open for developing traders. There's other trades that are setting up here. Now remember, where's the stops? They're there. So the question becomes, what is the trend? Daily trend? Up. What's too low? This. That's what we know. We get under here, it sets up targeting below, but we haven't. What does it say? Too low. So then any of these rotations, as long as there's a structured trade that sets up, can be continuation longs. Getting short off the IB is a counter trend trade. I always suggest, and it's even the way I like to trade, is I just trade with one side. I trade with the dominant side. I'm not into getting cute. I'm here for profit. I'm not here for keeping busy. I'm not playing a video game. Now, other traders are adept, and I'm adept at trading both sides, but I'm going to say, if I get short here, this is where I would be going. But the trend is what? Up. You need to be making a case, in my opinion, for why you want to be long only today. So what happens is long, and then you get taken out on trailing stops. Comes down, you're looking for continuation trades. You haven't seen me talk about any shorts except this, and it's not a trade I take because of that. Is that logical? Guys, I see there's some questions about scalpy and time frames. Scalpers, you got to define time frame. Scalping is what, you know? But most traders who operate in a very short time frame, the risk-reward ratio doesn't work. But you have to vet it. This is not a business of action and frequency of trading. It's really about positioning where you have range to pay for the stops you're going to take anyway. We all take stops. So, and the thing you really need to do is not buy anybody's ideas. You have to vet them. That's why when you jump around, the chats or educators, you see all these different elements. Don't take anybody's word for anything, me or anybody else. It's not about the word. It's about what you relate to and what speaks to you. And then if you need to extract metrics, if you don't know where your edge lies, you're sitting with the gamblers. So there isn't any one way to do this. I happen to subscribe to the idea of keep it simple, the KISS rule, because the more variables I put into this, the more randomness I bring to it. And that means I can't measure it. But you have to do what works for you. So, but you're going to see a lot of different, there's a bunch of streamers here in the Bookmap server, and you're going to see all kinds of different approaches. But you have to vet it. If you just plug somebody else's process in, and you add more randomness, then you can't measure it. So you got to find out for you what works. So now remember the possibilities. I can come here and rotate to this outside edge, or I can squeeze. So for me, the probability of 82% leans here. You see, the market is short, so I won't take any shorts. Not a recommendation. You can take all the shorts you want to take, but if you do take a short, you're looking at this and maybe a bit lower to an outside edge. Let's look at where this might be. It might be out here. So if this goes into rotation, it can do this. So if you get short, you're looking for this. It's called mean reversion. But I'm looking at this. Now, remember I was talking about conflict in a vertical integration at the top of the street. What is this? This is just above yesterday's high. 82% probability to get to yesterday's high, unless you think we're going to take out yesterday's low. We don't have to go anywhere. And this is a retail price that was too high that we left behind, and we didn't tag it. What does the market tend to do? What's too low stops, fuel. What's too high? So the trade for today is long, primarily, to here, to there, to there. Multiple time frames. Longs only for me. So, like I say, if you want to trade shorts, it's your business. And literally, it is your business. For me, if I get whacked and get stopped out, happens to me every day, almost, and I'm okay with that. And this is where range and time frame comes in. Because if I'm taking, my risk tends to run a couple of points. But my range that I trade is many more points, targets and statistical probabilities. So I will hold the trade and use trade management. If I find, as an example, here, this is a sweep. This can be a long coming out of here. This is where my resistance is. See what happened here? Reaction. If I get above it, then I can use it as support. What happens here? Absorption. Absorption. There's the icebergs. All these are suggested. If I can clear this, and you'll see what's happening is there's 1,500 icebergs. That's some pretty heavy selling. And there's 900 over here. See? If I can get above it, then this can become a support area. And this is where my sellers were, and the buyers absorbed them, the passive side. The only reason this isn't going down is there's a buyer here. Well, there's a buyer there too. Same guys that were buying over here. So then what? Well, I got my sellers here. If I can get through these sellers, then I can go to my statistical probabilities. So that's why, for me, I don't take a short. I just take my lumps on the counter rotation, because I expect that when the one leg gets long, then there's going to be, these longs have sell stops, right? It's the same concept as this. I get shorts in here who take out the longs in the leg, then I can, once they're cleared out and now I have shorts, I can get long to squeeze those guys out. This is what two-sided trade is like. If I can get above here and I'm above this, I'm still going for this. And I'll get taken out, stopped out, thrown under the bus with the rest of us. It's just trading. So what do I know? Buyers are here. Absorption. In hindsight, so if I come back to it, I'm going to look over here. Statistically, see? So I'm putting together these multiple elements. I'm not predicting what it'll do. I have no idea. What I know is the market is short from yesterday, 82% probability to take out yesterday's high. It never has to do it. I just take the trades. I put a helmet on. I look to get risk neutral. It's part of my plan. And then I get a free ticket to ride. And either it does what it's going to do or it doesn't do it. And I go on to the next trade. That's it. You guys have questions? That's trading in the Trader Lab. Not saying it's right for you. And I'm not even saying you should do what I do. The idea is find your time frame. Get in alignment as you define it. Be ready to change what you do if the condition changes. Has the condition changed? I don't believe so. Does that make sense? So this is a Trader Lab. You can learn this process. It is not complicated. The thing about trading, and it always will be the same, is it's random. Rotations are random. If we're operating in randomness, remember how the casinos work. They play games that have a specific edge, and they play them exactly the same way. That's what these trades are, exactly the same way. What's not the same is the randomness of the rotations and the participant behavior. If I can reverse engineer and know market mechanics and behavior, I can anticipate where I might get a reaction. This is what this auction is all about. What's too high? What's too low? What's fair? Right now, this is the fair price. So what we're trying to do is find what's too high. And that can be in any of these legs, because now there's stops here and stops under here. If I can't get through this as an example, where I've got my liquidity, I can counter rotate. You see? So right here, I got to be conscious. Look at that, 1,800 selling icebergs. So these icebergs and 1,000 over here. So I have the selling here, and what's happening is this is like Pac-Man. Do the buyers consume the sellers, or do the sellers consume the buyers? If the sellers consume the buyers, then the stops, for example, in here can get lit up because now the sellers are overwhelming the market orders, who are buy stops and buyers. So if the sellers overwhelm these guys, then the longs in here can get thrown under the bus. If the buyers can get through here, and who are the buyers? Maybe the shorts. So if you're short and your stop is sitting here, and the previous retail price that we just missed checking yesterday is here, would you want to be selling, or would you use counter rotations to cover your short, which builds buyers in underneath, in spite of the selling here? Think of it logically. This is not a neutral day. You got to take out the first hour's long. It's two-sided trade, but the edge goes to the longs. And that goes back to the higher time frame where we had an excess yesterday and we hit our downside targets. So in a way, what we're trying to do here is we're squeezing out the shorts from yesterday. So this is not something that you're going to get off any indicator. This is really understand market mechanics. Remember why the market went down yesterday. Now, I understand there was news, but the market needed to go down. Now, whether it will, when, how, that's part of the joy of randomness. But the market was set up to fill that gap because the market needs to go up to go down and go down to go up. We did our go down. We had a tail. We closed inside of a consolidation that we broke out of where that gap was. So we went down, came back up. Now we're inside again. That puts us back in the. Let me show you this again. Just give you perspective. This was the gap, and this 95 at the time. This is where the target was, and we got there. Now it doesn't mean it won't go. Wherever it goes, it goes. But this was the target. And yesterday, here, now remember, 90 was a target coming from there, too high, sell stops there, sell stops, gap. This wasn't here at the time. This is where, 95 is where we were going. Now, this all changed because the volume came in from yesterday, so it changes these locations. So that's too low. This was the fair price from yesterday. If it's too low, and that was too low, this is where the long started. What do I have here? The buy stops, 82% probability to take out the higher low. So for me, because that's too low, it's only longs. You can get short, doesn't matter. There's no monopoly on knowing anything. But this is where I'm looking to go. And that's all statistically based. And if I can get through here, I can also, if I get above 90, then I'm looking for a new all-time high, not a recommendation. And we may never get there. It's not my job. My job's to get in alignment. After that, put a helmet on because it's random, you see. So that's how this works. This is auction market theory, shopping. So are you a shopper? That's the initial skill you need to know when to throw, when the price is too low and you can't buy it here anymore. You throw 5 in the cart, nobody knows. And then as the price is getting raised, because the buyers are willing to pay more, we can see it going up. The other part of trading, part of the thrill is when the market gets lopsided to one side, it can counter rotate and take out all the weak retail traders like us. And then we get thrown under the bus. But if I know I have potentially, and that's all I got, too low, I'll keep buying it. And why? Again, because the market is short, market goes up to go down. And what did we do yesterday? We went down. And where's my stops? There. See the rationale? Not a prediction. It's market mechanics. That's how I trade. And this is using the auction. In other words, the shoppers. Traders are shoppers. You know how to shop? You got something going for you. Then maybe you can take what you already know and then bring it to trading. Because mentally now you have a connection to something you understand. It's not some esoteric foreign experience. It's a rotational experience, which means the randomness of the rotations. That is what we have to solve for. We can't predict the rotations. What we can do is vet structured trades that when they show up and they're in alignment with what we perceive to be what's called context, then we can use that and take our stops when it's appropriate and the rest of it, and have a trade plan with edge. And over time, not in the next trade, but over a random distribution of outcomes, extract a statistical edge that gives us an edge to get there with an 82% probability, not a recommendation. Now, the other part of this is a tweet can come out or somebody can trip over the cord at the CME and the market can do the Acapulco cliff dive. That's part of trading, just the way it is. So as long as the quote trend or context is up, I only take long continuation trades. And again, it doesn't mean you can't take shorts. But where do you think the path of least resistance might be? What do you think the shorts are doing from yesterday? You see what I'm saying? Do you want to join the retreating army or do you want to join the advancing side? That means continuation trades. So think of these counter rotations like counter attacks. So what I do, and again, it's just me, I'm not saying it's the best idea, is if I get taken out and what is happening on these counter rotations, if I perceive the trend is up, here's what's happening. I got longs in here. The shorts are getting squeezed. So I'm going up on the buy stops and buy yours. And then if the market gets long, I can counter rotate into the weak sellers. Now I have sellers in here. Think of it like this is what rotation trading is. So when you're thinking of quote scalping, what are you doing? Are you going to be able to be profitable by the time you get in here and by the time you get taken out? What do you got for your risk? I'm more inclined to let these guys get taken out, look at the sweep, see the absorption, and look for a long to get the shorts out. Because now the trend is up. Why would I get short? Wouldn't I just look for continuation trades? Wouldn't I just be looking for continuation trades wherever they show up, you know? Because of that. I'm just asking you guys the question. So for me, no shorts today, unless I'm a counter trend trader. And given the condition of the market, counter trend for me is trade management. I wouldn't initiate a trade. And that's only me. That's not saying it's right. I'm just talking about me. Are you guys with me? Please give a like if you're visiting in YouTube. I tried to do something a little different today. I really wanted to try to give you guys the idea that's very complex for us is this vertical integration of time frame. And I really wanted to take it, which I think I did, to show you why longs today. Now, the problem for us as traders is where do you get long, right? Well, I know the retail price from yesterday was there. And I know I have shorts. So why would I get short if the market's short? I want to get long because who's covering? Who's buying the shorts? And new buyers. So I'm a new buyer taking advantage of counter rotations to get here and wherever, and it never has to get there. So I manage my trades. I just go, I don't know. You know? How about this? You know, you don't know. If you know, you don't know. You're not in the prediction business. You're in the maybe business. Maybe it'll do this. Maybe it'll do that. Maybe it'll never get to the target. Maybe that 82% probability, which is not 100%, maybe it'll never get there. Maybe it'll never get here. These are targets, not a recommendation. Does it make sense why you might be long today and not short? What do you guys think in YouTube? This logical, not predictive, logical. What do we do in Trader Lab? The whole thing about this is understanding how the market works, why it does what it does. Why do we blow out the longs yesterday and fill that gap? There's good reason for it because the market was long and the sell stops were under the gap, right? And that area from a market or auction market theory behavior was not auction. When you leave gaps, what does it mean? I don't know. What's it worth down here? I don't know. Where's the stops? Oh, top of the gap. What happens? Let's clean everybody out. Why? There's sellers there. You know it. I know it. And so does the rest of the planet. If we get those sellers out, and we don't know how low it'll go, part of the joy, and then I find my buyers, now I got my shorts. The shorts, and 95 was the target. And I think I showed this at the top of the stream. I don't know if you guys want to see it again, but this is the current, by the way. But there's a 95. This was our over here. I'm not paying that. Get out of here. 95. Oh, it's on sale. See? And there's my tail. What that says is the market came down here and then the shorts covered. If the shorts start covering, and this is my retail price, it's right at 37.25 here, 37 retail price, and the shorts, we had our shorts already covering, and we came back into where the gap was. Does that not suggest to you that maybe we'll come here? Where's my low of the day? You see, this is the method. The method is the auction. It is not predictive. It is about alignment. So how do you trade this thing? Well, if you can understand what it might do, then you know where it might happen. You don't know, we could have just as well gone, wherever. And then you have to wait for a structured trade. So I know if I get my buyers first and I have an opening swing low, I know I can come down to take the buyers out in that first up leg. So I had that. Then I have my location down here. And then when I come across, I can then be looking for my long. That's what I know. And that was the first long was down in here. And then I have my targeting statistical probabilities all the way up the financial food chain. Once I come out above here, which has a high probability, I have a sweep here. This is a continuation long. We go there. It's all in the Trader Lab. And nobody knows. So we have to get over that. Okay? Are you guys tracking? This is the Trader Lab. And no, I'm not there's not high volume of trading. I'm not trying to trade a lot. Let me tell you about trading actively. Isn't it logical to you that the more trades you take, there's more risk? So what makes more sense here? More trades, more risk? Does that create more opportunity or just more risk? So now you have to figure that out. I have been a high volume trader. I don't do it because every time I expose myself to risk, if I'm going long, long, you know what? Long, 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 stop. Oh, long, stop. What? See? Or long, hang out in the Barca lounger. Oh, get taken out. Long to here. Counter rotations, sweep, long, going there. And I'm also scaling to get risk neutral. So is it more trades, more risk, playing a video game, or is this a strategic endeavor? Squeezing out the shorts. Which makes more sense to you? And again, I'm not trying to say do what I do. It might be the worst idea on the planet. The thing is, you need to extract an edge and know it's not percentage of winning trades. It is the risk and the reward. My thing, put a trade on, trade with statistics, get risk neutral, manage my trade, get taken out, go, gee, that was interesting. Do I have another location to operate in? And I have one right here. For there. That's the trade. Would you be okay getting long here to there? What do you think? 15 points. Are you willing to risk 3 points? 4 points for 15? That's a 3-to-1 ratio. Or are you going to risk the same amount and you're going to play a video game? And yes, you're going to have winners and losers. How do you think that's going to turn out over time? I'm asking you because if you can't answer the question, you're gambling. Because the answer is in the statistics. That's what a edge is about. Where's your edge? My edge is the rotations, the larger ones. I'm going to use the counter rotations for continuation longs. And I don't know, don't know. I don't need to know. You know why I don't need to know? Because I can't know. So if I know I can't know, I'm not working on trying to be right. I can't be right in a random environment. The thing that creates right for me is edge and my plan. How do I measure myself in this business? I measure myself not by the outcome of any trade, but by following a plan that has an edge. At the end of the day, no matter what, did I follow my plan? If I hit my loss limit for the day, which doesn't happen too often, but everything happens because there's going to be days where my plan and the condition of the market are not in alignment. That's not going to be a good day for me. Okay? And then I have to acknowledge that and go, well, that's just part of the randomness and the distribution of, randomness because it's random. Okay? The casinos don't change their game because they just paid the gamblers on the last hand. Can you imagine? Now, but what do we do as humans because of our fear and our primal wiring? You take a stop. The next trade you put on, you change it. Oh, I just took a stop. I'm not going to take the next trade because I want to be sure. Why? Because you're still emotionally attached to the previous loss. You see? Or this time, I'm going to move my stop quickly to break even because I don't want to take a loss. Can I ask you a question? What does that have to do with the last trade? Do you do that? Or I'm behind. I just took 2 losses in a row. I'm going to get out because I want to recover my loss. I don't want to go home with the loss. What does that have to do with the next trade? Is that what you do? If you're doing that, then you need to come to Trader Lab because those are the things that'll take you out of the business. Every trade stands on its own. Every hand the casino deals stands on its own. The casinos accept that the outcome of the next hand is random. They don't change the game. If they pay a gambler $100,000 on the last hand, the dealer's not going out behind the garage and stepping on a rake 5 times. They just deal the next hand. They don't change the game. What do we do? Oh my God, I got 2 losses. I just want to get even. Is that you? That'll take you out of the business. You have to treat this like a business, and you have to understand that every business has cost of production and overhead. Your emotions have no place here. And it's not that you can stop them. I tried for years. My goal was to turn into Spock. You know who Spock is? No emotions. I'm serious. I visualize I don't want to have emotions. That would be great. Well, I could, and I had things like I did behavior modification. I had a thick rubber band on my wrist, and every time these thoughts would come into my head, I would snap this rubber band. It's pretty painful. And I thought, behavior modification worked on my dog. Why not me? Well, not a dog. Instead, my primal wiring is to avoid risk. So what was happening is with this primal wiring, and yours too, is to look for certainty. And that's why you load indicators, time frames, and everything, the holy grail to create certainty and avoid risk. And you start looking at percentage of wins to validate that you know what you're doing. It has nothing to do with your percentage of wins. It has to do with risk reward. If you're trading the range, you don't need a lot of winners. You need the range. So, and the way I look at it is, I am not impacted by taking a stop. And now emotionally, I feel it. Disappointment, all that, right? What does that have to do with this? Nothing. Guys, please give a like. I'm out of time. Feel free to visit the Trader Lab. Use the link in the bottom of YouTube if you're interested in learning about the auction market theory, volume profile, creating trade plans, and the business of trading. Thanks again, guys. I'm sorry I went a little over today. Hope you got something from today. Don't forget to leave the like, support the stream, and I look forward to seeing you real soon. And come to Trader Lab. It's a serious community of like-minded traders who come together to leverage their collective experience. It's about the business of trading and potentially creating sustainability in a career path. Take care, guys. Look forward to seeing you soon. And thanks so much for visiting the Trader Lab.